Thank everybody so much for being here today, and we're going to kick back. Markets are closed. It gets, we don't have to worry about the ups and downs, especially like Friday, man. It'd be hard to focus on doing a kind of a workshop on Friday when the markets are going crazy. But anyway, that's what I like these Saturday events. Again, welcome. Thanks for being here. We're going to, dive into how to trade uncertain markets with low risk, high return option strategies. The two of them that I really like a lot are the butterflies and long condor. So that being said, let us get started. So first off, a little background on myself. I started my trading journey back in the 80s, and so I kind of pinch myself now when I think about that. But it's been an exciting time, and I was fortunate to start with got into with an oil company called Coastal Corporation, and they would actually have a training program to teach you how to trade. So trade oil and oil products like that. So they were a very large integrated oil company with refineries and shipping, all that kind of stuff, pipelines. They had the whole works. But so got in that program, spent about three and a half, 4 months down. They had a refinery down in Corpus, Texas, and sent me down there. And it was great because they would just, teach you, the process of oil, how you bring in an oil tanker, put it, the oil into the refinery, make the distribution of the products, distillation units and how that worked. And then, ship the products out, and then eventually got into the shipping department, did operations, shipping, chartering, did all that kind of stuff. And then finally got on the trading desk, the cargo side, cargo trading of oil. And they sent me out to Singapore for a couple of years. That was fantastic. If you ever get a chance, make sure to check out that city. It's an amazing place, fantastic food. And spent 2 years there, about 2 years, traded products, learned all about that. Asian products, a lot of MoGas, fuel oil, Asian crudes. And then got a job with a company called Transworld Oil. And at that point in time, they were the largest oil trading company in the world. It was Transworld and two others, Febro and Mark Rich. And so that's really where I started trading options. So I spent about 17 years with Transworld, about 16 of those years out in Bermuda. That was the corporate headquarters, and ran the international trading desk for 10. So that was a really unbelievable experience. I mean, we were into trading, we pretty much were trading everything, all the futures markets, foreign exchange, all the different energy markets. And right about here, 1987, started trading my first option trade. And so what we did, we were starting to trade options on crude oil. So at that time, it was, there was, really, the option trading was really, for the CBOE on commodities like grain, all the agricultural commodities. But the Wall Street guys started doing their dog and pony shows, coming to the different oil companies and traders, trying to promote, options and trading options. So that's, when it actually took off. And so they came down, we got our trading model set up, the Black-Scholes model on our computer, and learned all about that. But, really didn't know much about options. So it's kind of learning on the fly. And we were just basically selling options for premium. But that, really was my start, and I've just never looked back. I've just been passionate about options ever since. So just a little background there. And so that being said, let's move forward. So the following workshop presentation today is purely for educational purposes. Any stocks, futures, or options mentioned does not constitute advice and should not be construed as a recommendation. So, again, I've been, like I said, trading options for over 30 years. And what I've found is that the most valuable go-to option strategies that can really help any trader or investor more than other strategies out there, and especially when we get an extreme market uncertainty like we've just entered into over the last, kind of week and a half, 2 weeks, come down to using what's called the option butterfly and the long condor. These are option spreads. So I kind of call them my trading secret weapon. So the great advantage of these strategies is their really unique option framework that's designed to take advantage of, time decay and volatility, which are the kind of the two main option pricing components. So, we can use these in any kind of kind of market environment, which makes them great. But when we get into really high volatility, uncertain markets, they're kind of the go-to strategy. So if you just know when and then how to use them, they're going to be, a really great way to, feel more comfortable trading these kind of crazy market environments that we're just kind of into right now. Now, because they're structured to require only a small amount of your hard-earned capital, that's what really makes it great, is they can really offer you returns that can be very explosive in, even on smaller amounts of capital, which when we get in market uncertainty and volatility, we want to kind of, tighten up on our capital at risk. And so these are two strategies that really help you do that. And I kind of call it like lightning in a bottle. My first boss at Coastal, he used to get really excited if we had a really good trade. He would say, "Oh man, this is like lightning in a bottle. I wish I could, bottle it up." So that's kind of how some of these trades are. If you could just do it each and every time and bottle that up, you'd really have something. Now, when we look at the butterfly and the long condors, they're very dynamic. So they can be traded for a lot of different reasons with, kind of different goals in mind. So in other words, once you learn how to trade the butterfly and the long condor, you're going to be covered for your, offense and your defense. So the goals and protection, and you can really, again, define your risk, lower that risk, but still maintain great returns. So these strategies can work no matter what the markets are doing. So we could be in an uptrend, hard downtrend, sideways markets. They really help to take the unsettling guesswork out of your trading, eliminates that stress of having to be perfect on a stock's direction on the overall market, eliminates the time decay expense that you encounter when you're, having long options. And that's a real obsession, if you're trading options and, you've been, long options, the feeling when it's not going your direction you need it to, you're just getting eaten up each day from that time decay. But these two strategies will give you what we call positive theta, so, no theta decay. Now, they can be structured for very low cost, low capital at risk, and these strategies, especially the butterfly, will offer you, returns of 10 to 1 or higher. So I'll show you one today where we made about almost a 20 to 1 return on the trade. So they are really amazing. Now, the other thing when, with these two strategies, that they can be used when you trade, when your trade moves against you, when you make things, when you screw it up. We're going to have trades that go against us, and I'll show you a really good example here today of one we did this week. So they're kind of become what, kind of a fast, low cost way to cover your, what pronto when your position starts to move against you. And I've literally found no other hedging strategy that really comes close, to incorporating either the butterfly or condor, around your core trade. So by constructing these two strategies, or either a butterfly or condor around a strike that is under pressure, say from a core trade such as a credit spread you have on or a debit spread, it becomes a really great way to immediately neutralize and lower that risk. And I had one member, she said, this was Pam, she said, "I wish I'd known how to do this hedging before I lost so much money on credit spreads." And so that's, such a good point. So if you've done credit spreads, the feeling, be going really well for you. You'll get, you're chipping away, good little returns, but then you might have that one that goes through your short strike and it kind of messes up your whole, trades from, past trades that you've been making some consistent profits, you're wiped out. So anyway, I taught Pam, the butterfly defense, and it really helped her as far as hedging credit spreads, and we'll talk about that. Now, when we look at the butterfly, the core trade is very simplistic, actually, when you break it down. So here's just an example of, constructing a butterfly. So let's say you have a call debit spread. So you're long a call and then you're short a call, right? So that's what we call a call debit spread, and you've got your spread width here. So in this example, you can see down here, this is like 10.10. This was like on the NASDAQ 100, this example. So you're long a call at 10.10, and then you sold a call further out of the money at 10.20. All right, so you've got that spread. That's a $10 wide spread, or that would be $1,000 for one option contract, right? Remember, one option contract is equivalent to 100 shares. So you've got the spread width of $1,000, your cost of the trade, which in this situation would be $300. That's your risk. So that's your debit paid. Now the difference is your potential profit. So that'd be like 700 bucks, right? So that's a good return. Debit spreads are good, but there is, a couple things with debit spreads. One thing, they will still have you a little bit negative theta. But if you wanted to reduce this risk even more, we can quickly neutralize the risk, reduce it by just converting this to a butterfly. So we can, adjust trades into butterflies. So we can leg in, we can leg out, or we can just put them all on at once. So here's what we can do to construct a butterfly on a really quick adjustment if we needed to. So we sell a call here, buy a call, same spread width. This would be what we call a balanced butterfly. In this example, we're bringing in $200 credit. Okay. So now what we have done is we had the original trade had $300 debit, right, on that call debit spread. Now we brought in 200 on the credit. Okay, so what happens here? We reduce our risk down $100. Now the spread is still $10 or $1,000 wide. So now though, we have potential, our risk is reduced to 100. So now we construct our trade where we actually have the potential to make $900. So we just went from a risk of 300 to a risk of 100, and we just went from potential profit of 700 to 900 and reduce that risk. And so now we've got a potential for a 9-to-1 or 900% return. So that's the really cool thing about, using butterflies and condors and what I call mixing and matching your vertical spreads. So here's, what we ended up with. And if you go out here, this is what we call the tent, butterfly tent. If you go out at the top of the tent at expiration, that'll be your max profit. In this example, that would be $900 on your risk then of 100 that you reduce it to. That's a 900% return. So in this example, you're basically setting up a trade where you're now risking $1 to make $9. All right, so you can see the benefits that you can get from this kind of option spread. So question, where are you short and where are you long? Yeah, okay, so you just think about it here. Here's where you're long. You're long a call debit spread right here, that 10-10. You're short here, okay? So you're long and you're short. There's your call debit spread, right? That's a call debit spread. Okay, so that's your long position. Okay, right here. And then your short position would be your credit spread right here, sharing that same short strike as your debit spread. So now you're short call, long call. So there's your short position. And there's what we call a call credit spread. Okay, so now you've just made that butterfly. Now the other one that's great that we use these a lot because it gives you a wider profit zone. This is what we call the long condor. Not to get confused with the iron condor, totally different animal. So this is just similar to a butterfly. I kind of call it the cousin. But instead of, having the butterfly where we would have the short strike at the same strike as the debit spread, we're going to widen it out to give us a bigger profit zone, a bigger zone that we can capture the profit in. Kind of like, if you're if you're trying to capture a butterfly, you want a bigger butterfly net, it's going to be easier. So with the condor, we can widen out that profit zone. And you can see here, we've got a bigger zone of profit. Now we can do calls or puts, whatever, direction we want to do. We can just shape the direction using either, puts or calls to do that. Okay. Now, the next thing is what makes these things, the butterfly and condor, work, and what makes them so dynamic. So when we look at it, the most important option factor for profit generation, for the profit for the butterfly and long condor, comes down to really understanding how option pricing works. And the big concept of that comes down to time decay and what we call the other component is implied volatility. So let's take a look at, first off, the kind of this core concept or component, which is the theta. Now, theta, what it does, it tells us how much your option price is going to go down over time. So it's the rate of your time decay of your stock option. And by expiration, theta goes to 0. And the other component, implied volatility, also goes to 0. So when we're, doing a butterfly or a condor, they have what I call a sell side component to it. So it's going to be long option spread, but also short spread together. So it has that extra component where you're short a credit spread, which is basically you're selling time and volatility. So here's an example of kind of what this kind of looks like when you're doing a butterfly and how low the risk can be. So here's XYZ, it's trading at $45, and we're just looking in this example, just for a small move down, I'll put it down to 43. That's gonna be our target. So when trading, I always like to have a target. So a price target for your profit, price targets for, defense, okay? So in this example, we're looking for a target down to 43, based on, it could be Fibonacci levels, your indicators, whatever it is, but the example, we're targeting 43. So what I like to do is then set the body of the butterfly at my target. So here would be the body right there. So in this example, we're looking for a downside move. So I'm going to use puts. So I bought a, August 44 put, cost me $238 or $238. Then I sold against it the 42 put, the 43 put for $1.67. Then I sold another 43 put and bought below it the 42 put, which costs $1.06. So I've just now constructed, this would be a very narrow wing butterfly, $10 wide spread. 44 minus 43 is $1, all right? So $1 times, a contract is equivalent to $100, that's $10. So the total risk would be $10, on this butterfly spread. Now your profit, you just take your, easily you take your middle strike less that lower strike. You can see it's a dollar wide spread, less your debit. So in this case, 10 cents or $10. So times 100 to make the whole thing, an option spread. And then you can see your potential profit then would be 90 cents times 100. So that'd be $90. Now, you can see your risk then is $10, okay? So if everything goes against you, goes down or goes up, you lose 10. But if you go out here at that top of the tent, you would make 90. But if you go out anywhere in between, you're still gonna make a decent profit, but a really decent return on that low capital at risk. So here you can see you're risking $1 to make 9, so that's a 900% return. So that's kind of the concept of how it kind of works. Now the next thing is, how do you choose the best butterfly or condor strategy for your trading goals? So in my opinion, the major goal for traders really, in my opinion, should be to select trades based on what's going to give you the most consistent positive returns over time that have low defined risk and not always the biggest, returns like the home run. So, when you're trading, and especially when we're using options, we can just, kind of what I call chip away. We're hitting singles, doubles, and then occasionally we're going to be hitting that triple or that home run. But we want to just keep our risk. I first always look at risk first and then look at the return on that risk to see if it's worth doing. So if we're hitting singles and doubles, and then occasionally we throw in, we're hitting a home run, you can see your equity curve can start to build, and you're not going to have a real stressful kind of equity curve or market environment where you're trading like this. Now you can trade really, big positions on high volatility, and you could literally make, 50% of them you could make 45 could maybe be a winner, but then you have that one big, losers, and then that one big winner makes your whole year. But, that's a stressful way to trade. And in my opinion, then the better way is to, do it with where you're, just kind of building that equity curve, and then occasionally you get that home run. So you're just kind of building it straight up, from the left up to the right. So we can do this with options, and we can hit those singles and doubles, and then occasionally get that good home run hit, which will, I'll show you some good examples. So one of the best ways then to achieve this is by being aware of the different option strategies that are out there and available to you, understand how they work, and then go about selecting the one that's going to be best suited for the market environment you're trading, and also, your specific trading goals. So everybody here, will have a different kind of goals and different, kind of risk profile. So, John may be trading with $100,000, $200,000 account, and Donna might be trading with $5,000 account, or the other way around. So, you want to, look at your risk and what works for you. But these types of trades you can do on, small lots. You can do one contract, or you can do thousands. So they're very, very, they're very, very workable. for any trading account. Now, when I look at the butterfly, I call it the kind of the butterfly family. All right. So again, we're selling time and volatility when we do a butterfly or a condor. We've got that component, which helps the trade. So we could do a long call or put butterfly. We could do a broken wing butterfly using calls or puts. We can do what I call the unbalanced or ninja butterfly ratio butterfly. We could do the iron butterfly, the Lotto butterfly, which are really cool. I'll show you a good example on that. And then another really big thing is your hedging, okay? So when we get into crazy uncertain times now, this is a really great thing to know. And then the other one is kind of what I call the cousin. That's the long condor option spread. So you can see there are a number of different variations that we can use for different kind of environments that we're trading in. All right, so let's go through and I'll show you some good examples here of some variations of these trades and how they kind of apply. So first off, I'm going to show you a kind of a narrowing butterfly. But again, I talked earlier, if you're trying to catch a butterfly, it's going to be a lot easier if you have a really wide net, right? So we can, like with a butterfly, we can adjust our profit zone with the wingspan of the butterfly. So if we want to keep our risk super low, we can do a narrow wing butterfly, okay? But if we want to broaden that net so we can capture a bigger zone of profit, we can make it a really wide wing butterfly like this. So we can, adjust risk to and our profit based on the wingspan of the butterfly. All right, so let's take a look first. I'm going to show you a, setup on a directional long with SPY. And these are really great. We do, butterflies and condors a lot with ETFs because, the Russell, IWM are great, the QQQ, SPY, or index options. They're all great because they have good liquidity and so are, specific stocks. But this is on SPY. So here we've got, it's going to be a narrowing example. So we're, SPY is trading right here at $267, and we're looking for a target to 273, which is, I like to use, Fibonacci and moving averages, option activity, things like that. I call it a price target mapping. So with this example, there was our target was going to be right here about 273. You see that Fibonacci level and all that kind of price action through there. So this was set up, it was trading at 267 right here. So our target was to 273. So that's going to be the body of the butterfly is at that target. So we set this up and we did the trade here. We went and bought the 272 call, sold the 273, sold the 273, bought the 274. Okay, so it's a dollar wide spread or $10 wide. So max risk then would be, on this trade, it's a spread width of the dollar, so $100 less your cost. The cost of the trade was a 10-cent debit or $10. So if it went out your top of your tent right here, this would give you a $90 per spread profit or 900% return. So the trade though, over 2 days though, we ended up making $70 per spread. That's still a big return of $700 per spread. All right, so you can see how this can really control your risk. So here it went out right there. You can see the top of the tent, and you can see that black area. That's still the profit in there, right there. That's still what's left of time and volatility. But it went out right here when we took the trade off. So at that point, the spread went from 10 cents or $10 to 80. So your profit then is $70 per spread on that risk of 10. That's a 700% return. Now this is on 4 contracts, so that made a $280 return or $280 per spread return or 700% return. Now the next thing we're going to talk about is the wide wing butterfly. So this is where you widen out that wingspan, and it's going to give you that bigger, wider profit zone. So it's, again, these are structured for defined risk and great for hedging, used for targeted directional swing trades. So, when I'm looking at trades and everything that we do, I always tell our members and clients, trading is based on direction, your timing of your trade entry or exit, and then managing your risk. So we're going to target the directions, and this is kind of a directional swing trade strategy that we can use. They're great for what we call penny trades. I'll show you a good example of that. So that's where you know, at the end of a week or end of the month, you have, you know, wherever that market, your price goes out at a certain strike price, that's at expiration, we call that a penny. All right, so they're great for that. They're really great for trading high volatility markets like we're in now, because you're reducing your risk. Plus, think about it, when implied volatility goes up and you're selling options, you're bringing in more premium, so you get that benefit. Great for also trading really high volatility, high price stocks. I'll show you a great example of that. So you can trade stocks over $1,000 and you have a fraction of the cost to trade that stock. Trade duration typically could be 1 day, maybe up to 2 weeks. I don't like to go much further than 2 weeks, because when you do the butterfly, the real payoff comes from your implied volatility collapsing and that theta, you know, collapsing going into expiration. Great because they have positive theta, no time decay, get returns of 2 to 1 up to 20 to 1, that kind of returns. But before we get any further, I know some of you may want to take off early here or have things to do. I'll be doing a workshop next week, just focusing just on these two strategies. And if you'd like to join us, put in this link here. I'll make sure that go ahead and put in powercycletrading.com/special right up here. And here, let me show you, make sure you see this. I just plugged it into the box, okay, right there. So put that in, and if you click on that link, it's going to bring up a drop down where you can sign up for the course, and it'll show you what you'll get. But the course will be next Saturday. It's going to be how to trade the butterfly and the long condor, you know, for consistent income and manage risk. So to get, and this is going to be, I'm going to give you today a 15% off if you use the promo code of BF small cap 15. Okay, so you're going to get 15% off. So the course will be next Saturday, the 10th, okay, from 11 to 2 or however long we need. And then we'll finish up on Monday, the 12th, from 4 to 5, or, you know, later, depending on how much, you know, we have to cover. And then we'll do probably the Q&A the next day, so if you have any questions. But course package 1 with all the bonuses and everything I'm going to, you know, provide you is over $2,600. Now the price of this course package 1 is $197. So, you know, after the special goes off, the price is $197. But if you use that promo code BF15 today, it'll be $167. You'll get everything, the course, the bonuses, the recordings, all that good stuff will go through. So you're basically getting 93% off on that course package. Now, also then I have package 2, which will be, incorporates or combines my alert service, which we'll go through. Now that's $597, so it's basically including the alert service. If you use the promo code 15 off, you'll get that for $507. All right, so this is going to give you my alerts for the next 4 months, my trading club, plus everything in course package 1, all the bonuses, okay? So let me just click through that. I'll show you, make sure you understand how to use it. So click on that link, and that will pull up this payment link here, or this drop down, so you can order. Okay, so you're going to get this drop down. This is going to pop up, and you can see here, then just come on down here and you can see you're going to get your 15% off. Use that BF small cap, make sure it's small cap. And then for course package 1, here's all the different things you'll get. You can go through and see. We'll cover this more later, but I just wanted to make sure I put this out there in case you do have to leave early. So you get the live, you know, 4+ hour course, which is $197. But if you use the promo code, this will be $167. But you're going to get all my these additional bonuses today with the course. So you'll get my Fibonacci price target mapping course, which will be really useful. This is what we use in the course to map out our price targets for the butterfly. Then you're going to get my other course, Start Trading Options Today. So if you're just kind of starting out, this is a great package because you're going to get this course as well, kind of intermediate course to start with. So you get that, and then you're going to get into the butterfly. You'll get a 30-day trial membership to my trading club, so you can start it, you know, anytime. You can start, wait till after the club. So that's $97, or, you know, then if you renew each month, it's $97, or we have other, you know, kind of packages if you want to, you know, change. And then we'll do a live follow-up Q&A. We'll probably do that the very next day after the course on Tuesday. So you'll get that. And then you're going to get my option trading tutorial. This is another really little short course on option delta, gamma, theta, those things. And then my option strategy manifesto. This is going to be 15 other option strategies. Okay, so a really good course package bonus here. Total course value over 2,600. And today it's 197, but use that promo code, you get it for 167. So about 92% off. So you'll get the live course, then we'll do recordings of everything. You get the full training manual, handouts, so all that stuff. And then come down here and you'll see, you just click on this buy link right here. And then come down and put in small cap BF15, okay? And then click apply. And so there you're gonna get the price of 167. Then if you do want my trading indicators, which I always use in all my courses, here just kind of an example here, you can get all my trading indicators, which have my momentum indicators, the reversal, what we call volatility squeeze. It has all my indicators. It's a 5-study set indicator package. You can get all that if you want to uplink that. So that's 195. Add that to your order there, and then you're gonna get that full discount off that. So that's how that works. And then course package 2, just make sure you see what this one is all about. This one offers you my lead open to close trade alert service. So this service will give you 5 of my trading alerts for the next 4 months, and you can start and stop this whenever you want. All right, so this will give you everything in course package 1, but all my alerts and the trading club, instead of for 30 days, you're going to get it also for the next 4 months. And if you have to go off on vacation or work, you can stop and start when you want. Now, just a quick summary here. Since I started this service, the first alert service I started was back in May of 2018. And through yesterday, we've had 758 trades closed out. Okay, these are unaudited, but just kind of a summary to kind of show you how it's been doing. And we've had 547 winners, 50 break even, 161 losers, 79% win rate. So really good, high winning average on all the trades. And this will include all 5 of my alerts that I send out. Okay. So basically what you're going to get, and again, we'll spend more time on this a little bit later, but I'd send out alerts on selected breakout trades. These are kind of credit spreads. Selected calendar diagonals, we do a lot of those. Selected butterflies and long condors, and we do a lot of those. Earnings trades, we do, very selective earnings trades. I'll send those out to you. I'll show you one that we did just recently yesterday on Exxon that turned out great. And then another thing that I do, I send out these what we call monthly butterfly option pinning trades, which are really cool. So you'll get, all that for the next 4 months, all 5 of these alerts. So it's based on, what is the best trade I see, at that time that I want to send out. All right, so you get that. Plus, a lot of members just do their own thing. They just want the trades that I send out. Okay, and so that's what you're going to get. Then when I send it out, I will send you a trading guide for each trade. What option trade to use. I do a setup video review that night after the close. Trades are listed and archived. Then we do weekly, live Q&As that are recorded. Do a video newsletter, so you have access to that every day after the close. And then 60% discounts on everything I have on my, website, courses, and software. All right, so that's a kind of a summary there. So just come down here, click on that package 2, and then come down here and go put in that, BF15. And punch apply, and then you get that package. And again, if you do want the indicators, they're available to you as well. All right, so we'll cover more of this, and if you have any questions, but I just want to make sure I got that out there for you. Okay. Let's see, Donna, I'll have to look at your check your, just, you can email us at support@powercycletrading.com. So any questions, go ahead and send us an email. We'll get you taken care of. So here's the next one we'll take a look at. This is what we call a wide wing. This is going to be using a put butterfly where the spread is going to be $10 wide or $1,000 wide spread. So this is one, these trades that I'm showing you are also trades that we did either in the trade room, or these are alert trades that we sent out through the service. So this is one that we did on a short trade with QQQ. It was trading at about 314.60 right here. And we were looking for a move down. So we were targeting down here to this area right here based on kind of a Fibonacci area, that 382, and some moving averages coming in there. So set the trade up on the 23rd, and then, you know, the target got hit on the 26th. It was trading at 304. So what the trade was going to doing a wider wing butterfly. And again, our target was 304. So we did the 314, put long, short the 304, short that 304, bought the 294, so $10 wide spread. The trade cost was $2.10 or $210. Spread with a $1,000 wide less 210. So potential to make $790 per spread. That'd be a 326% return, or risking $1 to make $3.76. Now, if you just did the shares and you hit that target at 304, you would have been up $10.60 per share. You would have made 3.36% return. But there's a huge difference between this, you know, strategy versus just the shares. So that's what's so exciting and great about it. Plus the risk is so much less, you know, than buying shares. Okay, so that's the two really big benefits that couple of big benefits anyway. So here's what it looks like, that trade going out. Here's your tent, you know, right there, still some profit in there, but you know, you've got this really wide zone for your profit. So this one was going out right there on the 26th at expiration. So, you know, it went from the short strike setup, you know, when it was entered, now it was trading down to that 306 level. So the spread went from 210, where it was set up to, now the spread was blown out to 782. So this was up $572 per option spread. So if you did one spread, you're up $572. So 272% return versus if you did shares, 100 shares, you would have made 3.6. So you're getting that time decay advantage, volatility collapse, low defined risk, high return on your capital. But so again, think about it. So if you're, you know, anywhere in between here, you're going to have a good profit. And the closer you get to your target, the bigger the profit. But your risk is going to be capped either to the upside or downside based on your debit that you paid for the trade. And it's a positive data. So you're not, if the markets are going sideways for a while, you're not getting hurt on the trade. Now, this is what I like to show because this will give you an example of how you can trade a very high price stock with lower risk, and also how you make money going into expiration, where it just really starts to compound the profits to you because the implied volatility being stripped out and time being stripped out of the trade. So this shows you kind of illustrates that example. So this was back when I like to show this, was because it shows you all the things a butterfly can do in one trade. So this was back when Amazon was trading at, you know, like close to $2,000. So at this point in time, on the 29th of August, it was trading at $1,782. So now if you this is an option spread. So if you did, to do, one option contract is equivalent to 100 shares. So if you did 100 shares of Amazon, you bought 100 shares at that price, you're going to, be putting out over $178,000, right, for 100 shares. That's a lot of money and a lot of risk. Now our target, this was like a 200-day moving average, and we were targeting this area here, another Fibonacci area right there. So it was coming in 1830. So that was going to be our target. All right. So we're going to set up the trade targeting that. And we're going to do it at a fraction of the cost of what it would cost you if you wanted to go long Amazon, with the shares. So here's the trade setup. So it was on the 6th, it was trading, on the 29th, it was trading at 1,782. And then the option expiration was the 6th, okay? Our target was going to be that 1830 area based on the, what I call price target mapping, the fib levels, et cetera. So targeting 1830. So we bought the 1820 call, sold the 1830, so $10 wide spread, right? And sold the 1830, bought the 1840. So $10 wide spread or $1,000. Look at the cost of this trade. It was 80 cents or $80 debit cost. So that, versus if you bought 100 shares, you had literally been out $178,000 on the line, or your margin cost would be huge. But by doing the butterfly, we could do the same, control the same amount of, Amazon, 100 shares for 80 bucks. So we've got the spread width of 1,000 less the cost of the trade. So potential profit would be $920 per butterfly spread if we got a pin, but we're going to have a big wide profit zone anywhere in between. So that would be over, 1,000% return. So risking $1 to potentially make 11.5. So a lot better, less risk, bigger returns than, probably anything else that you'd be doing as far as any kind of trades that you're doing. All right, so here's where it was. Now this is the other big benefit. So here was this trade first thing in the morning. This was like about 9:30 or 10 o'clock a.m. Central. So it was trading right there at about 1836. It had actually blown over our target of 1830, but it was trading right here. So at that point in time, the spread went from 80 cents. Now it was up $230 per spread or debit. Okay, so it was up 230 was the spread, had blown to less your 80. So this was up $150 per spread, on your risk of $80. So that's a, 187% return, which is still a nice, really nice return, really. Yeah, you're always happy with 187% return, but see all that area in there? That's all still potential profit from what's left from time and volatility. So remember, this is first thing in the morning. Now here's the really cool thing. So here it is, about 4 hours later in the afternoon. Now look, see, there's hardly any of that black area left. See that little area left there? That's because time is being stripped out in volatility. So at the end of the day, time goes to zero, volatility goes to zero. That's a big part of the profit. So it was trading right here at 1832. So you can see it went from 80 cents. Now that spread had blown to $695, which was now up about $615 or $14 per spread. So a 769% return versus early in the morning, it was up 150 or 187% return. And if you'd done shares, 100 shares, your gain would have been 2.69% return on a huge amount of risk. So that really shows you, the huge benefits that you can get from, using the butterfly. And the condor is the same, not quite as big, but it's a great one to use and one that we use quite a bit. And so I'll show you some, examples of that one too. All right, so that's the beauty. Now here's a really cool one, and I always love this one because this is what we call your Lotto ticket. This is a butterfly pin, and this was on Tesla. So this was something that these are a lot of fun, and you can see how you can really, spike your equity curve on this one. And this was from one of my members, Bill. He said he really summed it up really well. He said, the butterfly strategy is one of my favorites. It's the big winners that eventually make the difference in any trading account. With all the so-called low-risk option strategies being sold to the public, an account without the potential to hit that big one once in a while not betting, I call it the ranch, but he said the farm, is a slow ride up a long hill. The strategy is easy as ABC, and he's got it really summed up. So here's what we did. This was one that we sent out. This is I've got 5 different types of alerts I sent out. This is one of the categories. So sent this out. This trade was set up, this was on the 8th of February this year. So at that point in time, we had Tesla was trading at 189.35. So I use was sent out. We use a service called Telegram. It goes out within seconds, but it shows you here. It says, use Tesla long binary monthly butterfly option penny trade. At that point, it was trading, when I sent it out, it was trading at 189.35. I said the trade set up for a potential monthly option pin at 200 next Friday. So it said buy the butterfly Tesla, the 16 Feb, 197 app, 200, 205. So it's a $2.50 wide spread at $12. That's 12 cents or $12, and that's your risk. So super low risk. Now this thing was actually pinned to the dollar at 200, which is, it doesn't happen very often, but it does happen. So you'll see it does happen. So here it was, the day of expiration. This was kind of midday. At that point, it was trading at 200. This was up $215 per spread. So it was up over 1,791% return. Here it was right at the end of the day, right going out at 3 o'clock. 3 o'clock, towards the end of the day, it was trading right here at 200. And so this was up now to 230 per spread, up 1,916% return on that capital of 12 bucks. Okay. So these things, do happen. And that's, you say, somebody said, hey, I just made 1,000% return. You'd think they're lying to you, but you can actually do this. So here's the trade right there. That's where we set it up, on the 8th. And then we were trading it for this pin right here based on Fibonacci, moving averages, etc. And that's where that went out on expiration. And so here was the trade structure. So we bought that 197.5 call. We were targeting 200, sold the 200, bought the 202.5. Trade cost 12 cents, $12 right there. $250 wide spread, 200 less 202 or 202, 200, see the spread width, less your cost. So potential to make $238 per spread if it goes out right there. If it goes out anywhere in between, you're still having a huge return. So that would be 1,198, 93, let me say that right, 1,983% return on that risk of 12 bucks. Okay, so that's, these things are really exciting when you get that one to hit. So here it was, perfect pin at the end of the day. But what we'll typically do, we're scaling out. We'll get out, take a little bit of profit, and then try to hold some for the very last day. And this one went out right there. So it went from 12 bucks or 12 cents to 250. So there's your max profit, 238, 1,983. Okay, so that's the potential that you do get with these types of trades. So that was a really cool one. Now the next one is another really favorite. This is what we call the long condor. So this is a long call condor that we did on Google. So I love these types of trades when we're looking for breakouts and we want to kind of set a cap, top and a bottom of the spread, and so we can really then reduce our risk too, and also have that positive data. So this was another, these are all alert trades that I'm showing you. So this is one we did recently. This was on Google on the 24th. It was traded at 179.26. And so here it says, here's what it looks like. It says new Google long, trade at 179.50. Daily cycle low retracement reversal up 21 EMA, 4-hour volatility squeeze. So I try to describe what's going on. So buy a condor. And so bought the spread here, the 180, 82.5, 187.5, 190 at around, you're not going to, 85 cents. Sometimes you get it less, sometimes a little bit more. All right, so that's what it looked like going in. And then here was the spread. So you're long the 180, 182, and short against the 185, 187. That's a condor. We had our max risk on this spread of $72. Potential max profit would be 178. And then we had, some profit take. I send out if we have any adjustments, I send you updates on what's going on. You can see here that on the 28th, it was trading around 182.11, and it was up to about $171 per spread or 237% return. So that's the condor. Again, a very low risk trade. So here's the trade setup. Right, entering the trade here, my system is based on momentum and reversals, things like that, and cycles. So got into the trade, it was trading right here, 179.50. And then we were targeting, I think we did an adjustment here, and then we took profit, these two profit takes areas right here. Okay, so we took profit on the 27th, it was trading at 185.41, and then on the 28th, it was trading at 182.29. So here's the condor, the profile, what the trade looked like with the expiration on the 28th. So we're long the 180 call, short the 182. So that's a call debit spread side, and then we shorted against the 185, 187.5. So here's what the profile looks like that with those two spreads, right? Then you've got your big profit zone here, and anywhere in between here is your profit and your risk is capped, from on this side, the risk is capped at 180 and then 187. Okay, so anywhere in between there. So the trade cost here doing the spread, $2.50 or 250, it was $72 debit cost, $72. So potential profit spread with the 250 less your cost, 178 per spread. If it goes out in here, you make $178 per spread, 247% return. Okay, so that's these are really great because low risk, high return, cap trade, positive theta. So one of our favorites that we do, and again we do a lot of these. So here it was going out. Here it was on the 28th. This was day of expiration. It was trading here at 182.29. So the spread then blew from $72 to 243 right here. So that was a profit per spread of $171 or 237% return. So again, one spread, 10 spreads, you can kind of do the math and see what can happen, but your risk is low. Okay, so that just drill it in. If you're in a really crazy market like we're now, you can handle maybe $70 of risk to lose, but versus if you're doing a high price stock with shares, you could lose a lot, right? Put it mildly. So that's a really cool thing to look at. Now here is something that's so important is hedging. Okay, and so I'm going to show you a couple examples here of what I call hedge trading management using the butterfly and the condor. So this was one that we had set up. This was a QQQ put debit spread that we had. So we were going to short the market using the QQQ, and we did it starting out with a long put debit spread. And then we were able to adjust it. This is what I'm constantly looking for. We were able to adjust this to a no cost free trade where we had zero risk. Okay, so here's kind of stepping you through the trade here. It was trading at 365 right here. So our momentum indicators, we had a cycle reversal, momentum was going negative. So the trade setup was based on looking for a breakdown. And then we had our target, always have a target area. Here was our target area was right here, this 355 area right there based on some fib levels, et cetera. A lot of different things we'll look at. So set the 28th and then made an adjustment on the 1st. At that point, we were able to adjust it to a free trade. And I'll show you how that happened. So it came off hard down here. When it was off hard, we sold against it a bull put credit spread, and that made the trade into a butterfly, and you'll see how it worked. And so then we had a profit take. It was trading at 354. See, this trade was perfect, 365 to 354. And then on expiration, it was max profit, and it was trading at 359.67. So let's walk through the structure. I'll show you how it worked. So the first trade, I broke it down by trade one so you kind of follow. So it's trading at 359. We're going to go short, okay? So trade one, we did a put debit spreads for a move down. So we 6 October, bought the 364 put, sold the 360. So we had a put debit spread like that. All right, now the trade, then the market went down. So this, though, our risk on this trade was $121, okay, $1.21. So that was our max risk, $121 per spread, okay, if you did one spread. The spread width here, it's $4, right, 364, 360, so $400 wide spread less the cost. So this had a potential really nice return of 279 per spread or 230% return. So risking $1 to make 230. Now what's been happening, or what happens a lot, is you'll get a big move, but then you'll get maybe a snapback. So what we'll typically do is when we get a big move down or up, we'll take some profit, or if we can adjust it to a no cost or less risk trade, we'll do that. All right, so that's what we did on this one. So trade one, we had, it was trading at 359, and then it, no, when we originally set it up, it was trading at 365. Now it was trading down, it collapsed, and we did trade two, it was trading now at 354, okay? So when it moved down hard, we were able to sell using the same expiration series, the 6 October, a bull put credit spread, the 354, 350 credit spread, and brought in $141, okay? So here's our free trade. Then we had the original trade, the long 364, 360 put, cost us $1.21. When the market went down hard, we sold an out of the money bull put credit spread, selling the 354 put, buying the 350, brought in $1.41 credit. So now we had zero risk. We actually had a credit of $20. So we turned this trade in. So if it went up or down, we'd still make 20, but if it goes out anywhere in here, we have a potential huge profit. So on the first, then it was trading out 354. So our profit was up. We had $152 plus the credit of 20. So this was up $172 per spread. And then on the 7th, it was trading right there, max profit right inside of that profit zone. So it was up $420 on zero risk. So that's the beauty of that. So those are things that you can do. We're constantly looking at. All right, so our trade had zero risk, potential to make $420, and our at risk was nothing. You know, we actually had a credit. Now here's one that we just did, and here's a good example. So here's Google. So we set this trade up on Thursday. Okay, so we went long Google, and let me just pull up the chart. I'll show you the trade. What we were doing here. Let me just pull this up, kind of walk you through it. Okay, so with Google, we went long right here. See, it was moving up here. So we're looking for this, you know, everything was, you know, everybody was, if you were in the, you know, last week, you know what was happening with the Fed and all that kind of stuff. So the market was really looking like it was going to rip, maybe breaking through that 382. So we wanted to set this trade up, but we wanted it to be very low risk trade. So what we did was we did a long call condor to begin with on this trade. Okay, so I'll show you what we did on the trade. So we set the trade up, and here's a very low risk trade going in. All right, so didn't want to risk a whole lot because this market's got a lot of volatility, but we put this trade on doing a call condor. Okay, let me get this where you can see it. All right, so what we had on, we originally had the long, the 9 August, that'll be next Friday's expiration, the 172 call debit spread, 175, 172, 175 call debit spread. That cost us $1.30, $130. Now potential on this trade to make 120, so about almost 1-to-1. But this trade was set up just as a condor, so we did this all at once. You can leg in or leg out, but we did this all at one time. So part of the trade though was selling the 177.5, 180 credit spread right here. So this is a condor, what we call a condor. So we're long a call, short the call here, short the call, on the call. Now our total risk on this trade is the debit paid less the credit received. So we had a total risk here of $70. Okay, so if everything falls apart, you know, the most we would lose would be $70. If it goes straight up, straight down, etc. Now, if we, yeah, and then here's our profit. Now, if it went, you know, right for us, our risk then is, our potential profit though would be 180 if it goes out in here. So 180 potential profit. If I can draw, risk is 70. So this would give us a 257% return. Okay, so that's kind of returns that are typical, 2-to-1, 3-to-1, right? Plus it's got a positive theta. All right, so that was the setup. Now everything broke to you know, went to, you know what, on Friday. So what we did on this trade, we hedged it and turned it into a butterfly, and we did it perfect, just pretty easily by just selling against it. The same series, the 9 August, we sold the 175. Hold on, let me get the right one. We did this into a broken wing butterfly. So we sold the 9 August 175, 177.5. And this then made an adjustment to this into a broken wing butterfly. Okay, so that's what structure looks like. Now look what we did. So we went from a $70 risk, now we're down to 45. All right, so we did this because when this thing came off hard, we were looking at, okay, we could either stop the trade out. At that point, the Condor had a loss of about $40. But by doing this butterfly, we have about the same potential max loss of $40, $45, depending on where you did the hedge. But the difference is if this thing was to snap back next week, which it could easily do, if it goes back up here to this 175 area, this thing is going to be up $205. See that? So this could potentially be up $205. Our risk is 45. So now we've got the potential. We're still in the trade. We've minimized our risk. So the most we can lose to the downside would be 45. All right. And then if we do get a little relief rally, and if it goes out there, we can make 205. That would be a 455% return. All right. So this, we're just buying time. And if it doesn't, let's say maybe it goes out here, maybe we make $100, maybe we make 20, maybe we make back 45 and we break even. Okay. So it gives us a lot of flexibility for the trade to just kind of sit there and wait, because anything can happen in this kind of market with this high volatility, right? So that's what we did there. And so that's what we call a broken wing butterfly that we adjusted it to. All right, so that is a really great example of that. Now, if you'd like to, master these high reward, low risk strategies that work in any environment, then here's what you can do now. So I gave you everything earlier, but there's obviously more to it than just what I could go over this morning. But I'm going to be doing a full-blown course on this next Saturday. Okay, so this will be a 4 or 5 hour course, and it'll start next Saturday. And make sure you use that link there. You can see good to get your everything and what you're going to cover in the course. I mean, what you'll get, and then I'll show you what we're going to cover in the course. Take any questions. Okay, let me see, make sure I got questions answered. All right, so you're going to get the live course, follow-up Q&A. We'll break it down, the course, once it's done live, we'll break it down in modules. This, will be yours forever. You'll get the full PowerPoint of the course and handouts, et cetera, and all the bonuses. So the course will be $197, but if you use that BF small cap 15 today, you'll get for $167. So here's everything you're going to get in course package 1, and also we'll get this in 2. So you'll get the live course. The course is $197. You use your promo code, it's going to be $167. Now you're going to get these bonuses along with the course. Okay, so you're going to get my price target mapping. So if you go to my website, this course is on the site at $297. So you're going to get that. That's a bonus. So throw that in there. You're going to also get my start trading options today. This is at $197 on my website. You're going to get a 30-day trial membership to the club. So you can start this anytime. If you want to wait till after the course, please do. And then you can renew it each month, or we got different packages that you can use. Then we'll do a follow-up Q&A. We'll probably do the Q&A too, see after the course, so you're fresh. If you have any questions, you'll get my option trading tutorial. Okay, this is on the Greeks, really nice little course. And then my option manifesto, 15 really nice option strategies, how they work. So full, bonus value, $1,035. So full value of this package, $2,635. It'll be $197, but if you use the promo code today, you'll get it for $167. Then you'll get all the recordings and everything, training manuals, everything there. So if you could use /butterfly BF, that'll give you that payment link, but just use that special link I gave you. So click on that real quick again, come down here, click buy, and again, just put in that BF15 right there, and you're good to go. You'll get everything that I just showed you on that course package there. And if you want the indicators, you can get those as well. So that's what you'll get there. And then your course package 2 just includes my 5 trading alert services for the next 4 months, plus the trading club for 4 months. And I'll show you what all that is again. And this is everything in course package 1 plus the alert service. It comes out to about $100 a month that you're paying for the alert service. Super cheap. And you get a lot of value for it. So this could be butterfly or long condors I sent out. Could be a counter diagonal. Could be a butterfly penning trade. could be a breakout reversal trades that are typically credit spreads, or it could be an earnings trade. All right, so that's what you're going to get, and then you'll get it for the next 4 months, all 5 of those services. So it depends on what trade that looks appropriate. I'll send that out, and typically we'll do 8 to 12 stocks or ETFs over the course of the month. They'll either be from these different categories. So a lot of members just want to do their own things. They just want the trades, and so they'll just go out. They'll buy the shares, but they'll buy options or whatever. But we'll always give you an option trade. All right, so I'll give you the guidelines, and then I'll send out alert adjustments or anything that you need to make corrections. So I use this service called Telegram. I'll show you that real quick here. And we'll go through some more examples, but here's one that we did. This is one we did an earnings trade. I'll show you this one. Was pretty cool. We did this one on Thursday. This was on ExxonMobil, and then I'm constantly giving you updates. Here's one that we did. We did the ExxonMobil update there. Here's the Google update there, and then we did this. We ended up Friday right at the end of the day. I sent out a short trade on QQQ. So that's part of the potential alerts there as well. So that's what that looks like. Again, so use your special code there, BF15. Make sure you use BF15 small cap right there. Yeah, I sure do. SSD. Here, let me give you the link. 1 second here. Where is it? 1 second. One second here. So use this right here, and that'll give you discount if you took it recently, then you can use that link. Please do. All right, so there's everything you'll get there. Yeah, so if you're a beginner, yeah, it's this actually a perfect package for you as a beginner, because here's what's so great about the package. You're going to get everything. If you just learning to trade options, you can learn to trade options basically for $167. Okay, so where else can you find this training? Okay, so I've been doing this trade options for over 30 years, so you're going to get it from me, for what that's worth, and it's actually worth a lot. And so you're going to get the butterfly course, which are 2 of the great strategies that I like. You're going to get all these bonuses, but you're going to also get this beginner's option course. So this was somebody just said, I'm a beginner and I use Robinhood. Is that okay? Or do I need to switch to Thinkorswim? No, you don't need. If they trade options, you just use whatever platform you want to use. I like Thinkorswim, but if you want to use Tasty Trade, TD, TradeStation, whatever, you can use whatever platform. A lot of people use Fidelity. It doesn't matter as long as they have options. You can use it. But you're going to get all this: the option beginners course, price target mapping, trading club membership for 30 days. Hopefully you'll stay on. Another option course here, this option strategy manifesto, everything for $167, and you're going to start your journey on trading options for a very cheap price. All right, so it's perfect for you. So go ahead and sign up, and you'll be glad you did. Now here's another just kind of repeat summary, and then we're going to go through. I'll show you some of the alert trades that we just done recently. So through the August 2nd, yesterday, 759 trades closed out over this period of time. 548 have been winners, 50 break even, 161 losers, run at 79% win rate. Again, unaudited, just a summary to show you what are being sent out. And I put a lot of time and effort trying to find these very selective trades. Now, here's what we're going to cover in the course. We're going to start out next Saturday with the option Greeks that are vital, for trading the butterfly condor. We're going to go through how theta decay works and how it impacts these two strategies, the importance of volatility and how that works, what we call volatility crush, that big pricing component for the butterfly condor, how that works, volatility works for it, how pricing of the option works and how it affects, time and volatility, how that has an effect on the option price. Then Fibonacci price target mapping, you're going to get this as a bonus course. And then this is going to show you how we set up price targets using Fibonacci and standard deviation for these high kind of probability directional targets. So we'll go through that. And then we're going to get into the meat and potatoes of the course. We're going to get into what really makes these trades work. We're going to go into how, why, and when to use every variation. All right, so we're going to go into the long call put butterfly, a wide wing butterfly, broken wing butterfly, ratio butterfly, broken wing ratio butterfly, iron butterfly, Lotto butterfly, vacation butterfly, long condor. So kind of like bubble gum shrimp. But I like the course because I go through every variation. Now, that doesn't mean that I like to use all these, but I'm going to show you with examples of how you would use it and then when to use it. And then you can pick out the one that you like the best for the certain situations, okay? So you're going to know then every variation, what they look like, how they work, the construction, and when to use them if you want to use them. But circling back, typically what we tend to always go with are just the wide wing butterflies, either using calls or puts, broken wing butterflies, sometimes a ratio butterfly, and the Lotto butterflies and condors. These are kind of the main go-to, but you're going to get every variation so you know what they are and how they work. All right, so the more you know, then the more comfortable you're going to be, with whatever you select as far as your trading that you're going to do. Okay, so we'll go through each and all of those. And then a lot of it comes down to, a lot of people ask, well, what are the best time frames? So we'll go through that, what time frames to use, what ETFs are the best index options to use, then how you do actually, profit from that volatility collapse and theta decay from the butterfly and the condor. Of all the option strategies or spreads, the butterfly will give you the highest return of any option spread strategy that's out there, as you can see from that Tesla example. How do you get those returns of 10 to 1 to higher? That's going to be a big part, to show you how I go about selecting those Lotto trades, what we look at there. And then another really fun part is the monthly expiration pinning trades that we do. So you've got monthly expiration 12 times a year. So when we get into a monthly expiration, that's where we really try to focus on trying to find these pinning trades. So we'll go through how that works and how, how we select our price targets for a pinning trade, how we do that based on option activity and Fibonacci levels. So there's a lot that's covered in this course. And then we get into the other category, the long condor, a full section on that, how the long option condor works. And so this one gives you that bigger profit zone. Now, it'll still give you great returns, 100, 200, 300% or more, low capital, positive theta when we use the condor. So a lot of times I prefer using the long condor versus the butterfly. So you'll see, what the different situations are, variations when we go to the long condor versus the butterfly. And there's specific reasons for that of how, why, and when to use. And then part 3 is a really big part, especially right now. We'll go through what I call the progressions of hedging, how we can, hedge from a stock to stock with a covered call, all the different structures, and then how to use the butterfly and long condor hedge for your core positions. And then another really big one, if you do credit spreads, is the butterfly defense for your credit spread or a vertical debit spread. And then we'll go through a step-by-step checklist of how, why, and when to put the butterfly condors on. So kind of that step checklist of that. We'll go through execution adjustment management, and then the exchange traded funds use. And then a very big part is the assignment risk, expiration, auto exercise. We'll cover that. All right. So you'll know, what can happen to you as far as, what to look for, not to be freaked out about expiration risk, things like that, getting assignments. So we'll go through that so you're comfortable with it. So it covers a lot of ground there. Here's from one of my good members, Richard. He said, Larry, you're the only one that I know that provides competent, realistic instruction on how to have a Houdini escape hatch plan to utilize the various types of option trades that go against you. So he said, he really words it well. He said, it allows a trader to calmly use their head to make appropriate trade adjustments instead of wildly panicking and having their head handed to them. So like Friday, I greatly appreciate you sharing your hard-earned profitable trading knowledge and techniques, Richard. All right, so here's your course package bonuses. So first off, you'll get that target mapping course, and you'll get that. And then use that special link that I gave you, powercycletrading.com/special. Use this link here. And 1 second here. And make sure you put that promo code in there, George. Okay, so get this as special one, price target mapping course. This is a bonus. So this goes through how to use, it's a combination of Fibonacci, moving averages, price action support resistance, standard deviation, and unusual option activity. I use all these together to give me what I refer to as my price target mapping. And so we use this kind of process to set up our price profit targets, maybe defense targets that we want to use, okay? So very big, important part of any trade that you put on in general. So it's a really good 3+ hour course on that. And then start trading options, the perfect one for if you're just starting out as a beginner or intermediate. So this is a course that will take you through, just the benefits of options versus stocks, insider tips you need to know before you start trading, the option basics, puts and calls, how those work, how option expiration works. And then I go through 3 different strategies in this course. Covered call, a really good starting strategy to use. And then the second strategy is using a protective strategy, the collar with the covered call. So that's a really great hedging. And then the vertical debit spread. So really good solid course there for anybody, especially if you're just kind of starting out. So you'll get that. Then you'll get my 30-day trial membership. You can start anytime, or if you do the alert membership, you'll get this for 4 months. So this gives you access to my virtual trading room, open every day from 9:30 Eastern to 10:30 each day during the week, Monday through Friday. So come in, see what we're doing. If you have a problem with the trade, come in, ask. I can try to help you out on what you might want to do on the trade. Then after the market close, I do a video newsletter update on the market, what I'm how my view on the market, what we're doing. The videos are archived. I do a weekly Q&A, live and recorded. And then there's also a good educational material for the members in what I call the educational vault. And then on anything on my website, you'll get a 60% discount on all additional courses or software on my site. And I always like to point this out. It says, Jay, one of my old really good members, said, reading books is fine, but seeing the actual option trade set up makes a huge difference. And that's really true. Seeing how things work, can really help you. And then bonus 4, we'll do that follow-up Q&A, which will be live and recorded. We'll probably do that the day after the course on Monday. And then you have access to the virtual trading room for that additional support. And then you're going to get my option trading tutorial. So this is a 60-page guide with videos, just mostly on the Greeks, okay? So the Greeks like delta, gamma, theta, vega, how those, what they are, how they work, option pricing, what's the market maker secret, how standard deviation is used, option delta, trade probability. So another really nice additional option course for your library that you can, have. And then last thing is my top 15 option strategy guide. So this one, if you've ever wondered what the heck is a back ratio spread, so this will take you through the trade construction, when it would be used, what's a vertical ladder spread, or what's a calendar spread, or long straddle, short straddle. So this is a really nice little additional bonus for you there. So really everything's option related for this course, butterfly, condor, but these are additional things you'll get. And then everything is recorded and it's yours forever, broken down 30-minute modules or less. And then you'll get the PowerPoint. Now here's the trading alert service, which you'll get this from one of my members, Waleed, who lives in Kuwait. He says, Larry, I have to mention one thing. I'm subscribed to a lot of services who send out trades. Some are good, others are not that great. But one thing I would like people on this webinar to know is when I get a trade alert from Larry, I do it blindly as time has shown me. This man is that accurate in his recommendations. Thanks for the great service. Thank you, Waleed. And then here's another one from Dan. He said, you're very diligent and totally thorough with your analysis. That is the foundation of the success of your alerts. I paid for my subscription with the first 4 trades I took with you when I was learning to trade options. So I try to make these as, defined as I can when I send out alerts. So for example, here's the one that we did. Well, here's the short trade that we set up right towards the close. Said new QQQ short, trade around 448.50. Says high risk momentum short, target 443, 440. And this one we just did a vertical put debit spread. So sent out that. Here's the one that we did on Exxon. I'll show you this one in a minute, but here's the one we did on Google on the first new Google. You can see it. See, these go out within seconds. It says new Google long, trading at around 173.80, daily cycle low retracement reversal. And it says buy condor, around 70. And then here's the adjustment was sent out on the 2nd on Friday. Here it says Google long, if long that condor, adjusting to a butterfly, and then I show you how to do it. Sell to open the 9 August 175, 177.5 call credit spread. Adjusted trade, then you adjusted it to a long call butterfly. So try to be very descriptive so you know what's going on. And so anyway, Dan was learning as he was going. So with each trade, I send out a suggestion option trade, but like I said, some members just do their own thing. I'll give you the entry level, profit targets based on that price target mapping, what option series to use, stop loss levels, target levels. And then I'm constantly giving a guideline, updates, guidelines as to what things may start using. Wait a minute. Okay. Hold on a second. All right, so any questions on that? And then trade setup video review. 1 second, just give me 1 second here. Okay, sorry about that. Back up and operating here. Yeah, so this is kind of what you're going to be covered there. And then let's go through a few of the alert trades that we've done recently, just kind of give you an idea of what you're going to get with the alert service. So here's kind of the summary I showed you here, but here's the update on the butterfly line condor alert. So started this part of the service back in May of 2019. Here is through yesterday. We've had 177 trades closed out, 124 winners, 13 break even, 40 losers. So run about 77% win rate. With the butterfly condors, we average potential loss when you take it off, maybe 50, 75 cents. They're very low risk trades, but the beauty of it, you get these potential big returns, 2 to 1, possibly up to 20, 25 to 1. So there definitely those are possible kind of trade returns you can get, as you saw in that Tesla. So here's one that we did recently. This was on ConocoPhillips. This was a put condor. So this was for a downside trade, for a short trade. And so here it was, we did this short on Conoco, and it was trading at, on the 22nd, it was trading at 112.35. And so here you can see it says new Conoco short. It was trading at 112.35. Momentum short based on breakout close below today's prior week's low. So targets, et cetera. And so said to set this condor up, this is a put condor, the 110, 109, 107 at around 48 bucks. And so profit take on the 24th and the 26th here. And so this was the trade setup, just kind of show you, what this spread looked like. So here was the trade breaking down below there at 112.35 based on our momentum, took it off right there. Here was the condor setup, and this was for a downside move using a put condor. So we're long that 112, 110 put debit spread like this. And then we sold against it, the 109, 107. So we made this condor, put condor, total trade cost 48 cents, 48 bucks, spread with 200. So potential to make 152 on that risk of 48. So, potential 316% return. And this one went out, we had profit take on the 24th and the 26th On the 26th, it was traded down to 110.31 right here. So this went from $48 spread that we put it on to 154, so up $106, 220% return. Here's the Google trade. I already showed you that one. We'll just kind of flip through that one. And here's another one that we did not too long. This was a net, NET. We did this, it was another long call condor. So do a lot of condors in this kind of, in the previous market where we had that 2-3 weeks of just big upside moves, we're doing a lot of condors. So did this one on the 14th, it was trading at 75.40, out on the 18th. So these are, anywhere from a week or less on duration. So this was, one that we set up for a total cost of about $52 and took it off the 18th. So I'll just kind of flip through these so you'll have time for questions. So set this one up right there and then close it out right there. It was coming up into our target. So this was another call condor. So long the 176 call, short the 178. So you can see this was spread with a $2 and then sold against the 80.82 call credit spread. All right, so total risk of 51 cents or $51. Potential profit, the difference, 149. And was going out right there when we took it off. So took this off, it was trading at 79.54. We were up about $73 a spread, so 143% return. Here was another one that we did with Meta. This was back on the 5th of June. This one was a really nice trade. Set it up right there, took it off right there. Profit take on the 14th. So another call condor, 490, 492. Call debit spread, and then the 510, 512 and a half. Total risk, $65 the spread cost. And potential profit would be the difference of 185. So potential to make 284% return. And if it goes out between your two spreads right there, and that's where it went out. So that was a max profit on the expiration. So it went from you can see the spread on this one went from 65. Now it was right there to 250. So that was the max 185, 284% return. So that was a one on Meta. And then here's the counter diagonals. Now we do a lot of these as well. And you can see here, and these are just a kind of different spread for a different kind of environment that we're trading. But these are ones that we do a lot of. So we've started this back in the June 2019. You can see right there, we've had 291 closed out, 213 winners, 15 break even, 63 losers, run about 78% win rate. Again, unaudited. And here's just a quick example of one that we did not too long ago. This was on Starbucks. And so this was a short trade. We initially set this up as what we call a put calendar. And then we did an adjustment into a put calendar diagonal. And then we actually adjusted this into a free trade into a butterfly. So I'll just kind of quickly go through and show you what it looked like. So the initial trade, we set up shorting it right here on the 26th, broke down. We did an adjustment, a couple of adjustments, and then on the 1st of July, we adjusted it to a put butterfly free trade. All right, so the first adjustment we did, we adjusted this to a long put counter diagonal when it was trading at 78.67. And then on the 28th, we adjusted it to the put counter diagonal. And then we took some profit on the 5th. It was trading at 76.03. So this counter diagonal went from $32, our adjusted cost there, to 142. The spread blew to 142, so it's up $110 or 300. I've got to correct that. That's not right. The actual return here is 110, and our cost was 32. That's yeah, that's right. Wow, 343% return. But what we did, what we'll typically do is we'll take some profit and we adjusted the balance here to a free trade by doing it into a butterfly. So the way this worked, and you'll learn this in the course, is we had our kind of a foundation of our long was the 77 put in this 12 July series. So we rolled the whole spread into the 12 July series and adjusted it to a butterfly. So we had the 77 put long, short the 75 put, short the 75 put, long the 73 put, and we did this now for $8 credit, so zero risk. $2 wide spread, potential to make $208, if it goes out, right at the butterfly tent. But the thing is, you can stay with the trade, not have to worry about it, and then see what happens. So here's how this one looked going out. So it went out right about here, went ahead and closed it out. So it was trading at up about $78 per spread on zero risk there. And then here's one that we just did. This was an earnings trade that we just did last week. The earnings trades we do a lot of on these, what we call double calendars and some others, but we started this back in June of 2019. We've had 126 trades closed out, big high win rate, 90, break even 16, 20 losers, run at 84% win rate on that. And here's one we just did last week. This was the one that we did on Exxon. We set this up on Thursday on Exxon. It was having earnings Friday before the open. So this is what we call a double calendar. So we set this up, and this worked out pretty well. So it was trading right here, went out pretty close to where it opened. So it was trading about 117 on Thursday when we set it up, and it went out on Friday about 117.64. So this was doing a double calendar, and so this is a really cool trade. And so it went out right there. So it was traded at 117.64. So we had, this is a combination of a call calendar and a put calendar right here. So total cost of 66 for the call calendar, 60 for the put calendar. So our total risk on this trade is 126, but you've got a really wide break even. So it's, these are hard to lose much money on. So they're great for earnings. And so this went out at, straight, the whole spread was 126 was the cost of the trade or the spread. And the trade, let's see, the trade we had, that spread when it went out was at 203. You can see here the 132.71. So the spread then blew from 126, it was at 203. So that was a profit. We were up here on this trade, $77 per spread. So in one day. So that just to show you kind of the variations of things you might get, with the alert service. All right, so that's pretty much everything. And again, use that link that I just gave you, and make sure you use the promo code there, BF15, and you'll get that 15% off. And that'll be pretty much good through today. And then you'll get the alert service if you want that. You'll get all, whatever 5 alerts, trade setups that I send out, various, depending on what's going on in the market. You'll get all that. And that's pretty much it. And I hope to see a bunch of you next week on Saturday the 10th. So any specific questions or anything right now, please